So I was one of the founders of Tether in 2014. In 2015, me and my partners owned 60% of the business. We sold that 60% for essentially nothing to our minority partners. So I've had no formal involvement in the business. And during my tenure, we were completely transparent because that was the original design.
Let's backtrack a little bit and talk a little bit about how Tether was meant to be. It's was meant to operate originally a bit like what we call a currency board, whereby you have a currency, and we see this in real currencies, in fiat currencies produced by places like Hong Kong, where the amount of currency they produce in their own currency is fully backed, 100% backed by reserves in another currency, in this case, the US dollar. And it is quite strict. They can't print any more of their own currency unless they obtain an equivalent amount of reserves in the currency to which they're pegging. It's known as a currency board. And that's how Tether was meant to operate. And so its website originally said that every Tether was backed 1-for-1 by an actual US dollar.
Wondering what exactly are stablecoins in the first place, because they seem much more efficient than Bitcoins, right? They have 0 transaction fees. They're pretty much free. They're fast. They have no gas fees. They have instant processing times. Why don't we just use stablecoins? They seem like the perfect currency. And so really from a practical standpoint, stablecoins are the ideal currency. You can not only use them as a store of wealth, but you can use them for daily transactions as well. The biggest current threat to Bitcoin, cryptocurrencies, is stablecoins. Oh yeah, stablecoins. They seem so boring. They don't move much at all. They're not very interesting to invest in. Their value doesn't go up or down. They just stay pegged at 1 coin equals 1 US dollar, or whichever country that you're dealing with. And yet the big money, the big corporations, the big governments are all looking deeply into stablecoins.
Although the value of a stablecoin may be tied to the value of a dollar, these coins may not come with the same protections as traditional means of payment, such as physical currency or the deposits in your bank account.
And the things that Tether has said actually said that Tether had effectively lied about what their reserves were made up of, because it had claimed they were made up of actual dollars, and it was evident that they weren't. About a week ago, consisting of 2 pie charts, which purported to be a breakdown of its reserves. And that's all it showed, was it literally just a pie chart showing what proportion of what it called its reserves, which is actually its total consolidated assets, which is not the same definition of reserves as would be used in a bank. It's actually a much wider definition of reserves than banks would use. Issuers can issue junk-rated paper, and we don't know what Tether actually holds. We still don't know. They also hold corporate bonds. Again, we have no idea what the rating of these is. The only thing we were told there is they're not bonds from affiliates, from members of Tether's own family of companies, which includes the exchange Bitfinex. And there are some precious metals, because Tether also issues a gold-backed token, and it does hold gold reserves for those. So that's really the breakdown of what Tether calls its reserves.
There's 75%, their largest holding, is in cash and cash equivalents and other short-term deposits and commercial papers. Now, a breakdown of this 75%. You have commercial paper, fiduciary deposits. Only 3% of that is in cash. Then you have reverse repo notes and treasury bills.
The Federal Reserve is charged with promoting monetary and financial stability and the safety and efficiency of the payment system. In pursuit of these core functions, we have been carefully monitoring and adapting to the technological innovations now transforming the world of payments, finance, and banking. The effective functioning of our economy requires that people have faith and confidence not only in the dollar, but also in the payment networks, banks, and other payment service providers that allow money to flow on a daily basis.
Stablecoins are going to play a very important role when it comes to the shift, because they are the direct replacement to the US dollar, guys. They're going to be the direct replacement. Facebook also announced their pilot for Diem, along with Silvergate, where Silvergate will be the issuer and Diem will operate its smart contract. It's a pilot, but it's significant because Diem will be a bank-issued stablecoin. She says Diem Facebook Diem will be a bank-issued stablecoin. There will be a lot of blowback towards Facebook, but it's bank-issued.
China banned all cryptocurrencies because they realized they did not want their own country's economic and financial data being leaked into Facebook, where Facebook could get full market data insights and transparency into whatever Chinese citizens were buying. That would be an incredible security threat to the country. So Facebook tried to get Switzerland on board as well. However, that deal fell through. After getting to an advanced stage of trying to acquire the Swiss license, the group Diem now planned to launch its payment system from just the US. So after all of these plans about launching a global coin that would be backed by a basket of international currencies, Facebook's Diem only got approval from the US and will launch only as a US coin because no other country was willing to release their financial data to some Silicon Valley company. And so it's important to recognize that these companies like Facebook, which are working on so-called cryptocurrencies, they're actually not on the side of Bitcoin because Bitcoin does not give you access to any of this data. It's just totally decentralized, anonymous. Facebook needs that data. And so now you understand why just recently Visa decided to also add cryptocurrency to its settlement platform, saying that they're going to accept payments in USD coin, which is the stablecoin created by Circle, which is also run by Coinbase. And again, USD coin has almost nothing to do with cryptocurrency. The only thing in common is it's called coin, but it's really this centralized virtual point that these companies have just decided to create together in order to track financial data.
If foreign governments are going to upgrade their currencies and make them digital, I think the US government, I think that we need to be doing something similar with our dollar. Do exactly what Tether has essentially done, but it should be being done at the Treasury and Federal Reserve.
Like it or not, one of the best things for this industry at present would be getting stablecoins to be okay with US regulators, especially the Fed and the SEC. Why? Because every US dollar must clear through a bank and then the Fed. Like it or not, US regulators have big power over stablecoins.
The Federal Reserve has been exploring the potential benefits and risks of CBDCs from a variety of angles, including through technological research and experimentation. We will ask for public comment on issues related to payments, financial inclusion, data privacy, and information security.
Now remember, guys, she's got 22 years of experience in this. She's the CEO of her own digital bank. If it's anybody that knows where we're going, it might be Miss Caitlin Long.
Sometime around about 2015, 2016, Tether's sister organization, Bitfinex, suffered a hack, lost quite a lot of money. And it turned out that they had borrowed from Tether's reserves to cover their losses. And they concealed the fact, Tether concealed the fact that they had lent this money, but it did mean that the Tethers were no longer fully backed by actual US dollars or actual, Tether actually covers other currencies as well. So they kind of started changing the way they described it from fully backed by actual US dollars to just fully backed by assets held in our reserves, which is where we are now.
Tether had very little bank deposits in its reserves, but now we know its reserves are mostly embedded in credit assets of who knows what quality, not T-bills or other short-term, lower-risk liquid securities. So, simply put, guys, Tether's money isn't Tether's money. And that was the biggest question that we were trying to ask at the beginning of the year. Where does this money come from? Is it legit? Now we're seeing that it's basically credit. I always challenge the business model of some stablecoin issuers, mainly because of their reserves. Now, here is some math on Tether's 58.2 billion of reserves. A conservative assumption is that Tether's reserve portfolio yields at least 1%. That's 582 million of annualized profits going to Tether's issuer. I can only guess how US regulators reacted to Tether's announcement. She says, tread carefully. I've thought for a while that a stablecoin crackdown is inevitable. Will this trigger it?
As stablecoins' use increases, so must our attention to the appropriate regulatory and oversight framework. This includes paying attention to private sector payments innovators who are currently not within the traditional regulatory arrangements applied to banks, investment firms, and other financial intermediaries.
I think Tether was heavily manipulated and was the cause of Bitcoin rising to an unrealistic number of 20,000 because they were actually, I mean, I don't know how long you've not been involved with Tether, but I think there was massive fraud in Tether, and Tether was being artificially manipulated. They were issuing phony Tether because there is no transparency in Tether. That's the problem, is they were issuing Tether in whenever it was needed out of thin air. It was not backed by dollars.
Tether finally disclosed how it invests reserves, and it was a big negative surprise. This news probably contributed a lot to the crypto sell-off on Wednesday. Why? Because now risk managers at crypto hedge funds almost certainly will require haircuts on Tether, which means traders had to sell crypto to reduce their total risk exposure. For example, if risk managers now apply 5 to 10% haircut for Tether, and Tether is in a trader's portfolio, the trader must bring down total exposure by selling other non-Tether cryptos. Based on Tether's new disclosure, both Tether's probability of default and loss severity in default just went up. If or when, a crackdown happens, I'll be shaking my head because some of the fallout would have entirely been avoidable if Tether had just invested its reserves in actual money.
I think the lack of transparency in an industry that is fundamentally philosophically built around this concept of transparency. And so what they did is, instead of being one-to-one backed, they loaned themselves, they borrowed money from Tether to one of their—
to buy more Tether. I get it.
Without notifying anyone. And I think that was a huge, I disagree with what was done there.
Just print up the stablecoins out of thin air like Tether. And so I think part of the problem is all of these concepts are mixed together and people don't know what stablecoin really means anymore. For example, they're saying here that Tether is fiat collateralized. No, it's not. It's just based on thin air. They're just printing this stuff. And then they're saying that USD coin or the Gemini dollar are stablecoins, and sometimes people get this mixed up with a crypto stablecoin, which is actually MakerDAO using Bitcoin. Do you think I'm going to be able to buy something from Switzerland? No, these countries have decided to regulate. China banned cryptocurrencies, Switzerland banned Facebook's Diem. And do you think that this original vision of this single currency to be used across everybody is really going to pan out? Or is the future more likely to be one where every single country has decided to issue its own central bank digital currency? And this takes us really to national security and ransomware as well. You know, digital hackings have been up 300%. In the Colonial Pipeline oil incident, hackers were able to extract $5 million of ransomware bitcoins from a US corporation. And this sort of attack really is enabled only through the ability to exchange bitcoins for a real currency.
Lowest point, it was roughly 70% backed. 70% backed is better than anything that you'd see in the banking system, right?
But with the banking system, you know it's fractional. Tether was supposed to be one-to-one. That's the point.
I agree with that. I agree. That was the original design was one-to-one. There's no fractional reserve anything. So I completely disagree with the decision, but it's not as bad. And the problem there was transparency, not committing to what had been communicated to everyone. And had they said, we're going to evolve Tether into a fractional reserve system that's going to be 2-to-1, that would be a different thing. The fact that—
But it was being specifically used to manipulate Bitcoin, right?
Then the second point was, in terms of the manipulation, I've not seen anything that makes me certain that that is true, but I believe it's certainly possible. We don't have enough visibility in terms of what's happening on the exchanges, who the users are, who's moving markets. And so I can't say with any degree of certainty. I hope that they were not involved in anything.
While also embracing innovation. In the Fed's early days, the development of dedicated telegraph wires facilitated the transfer of funds between banks. In the 1980s, automated clearinghouse services made it possible for electronic bill payments to be an alternative to paper checks. In 2019, the Federal Reserve committed to building the FedNow service, which will enable banks to provide real-time or instant payments to their customers around the clock, 365 days a year, benefiting communities across America. A way that has the potential to enhance payments efficiency, speed up settlement flows, and reduce end-user costs. But they may also carry potential risks to those users and to the broader financial system. For example, although the value of a stablecoin may be tied to the value of a dollar, these coins may not come with the same protections as traditional means of payment, such as physical currency or the deposits in your bank account.
Those categories is like core consensus improvements. One of the things that I've said a lot is that proof of work is kind of a technological dead end. It works fine. I'm not saying it doesn't work. I'm just saying that there hasn't been any significant innovation in it. There are also changes that are in the form of new features. One of the features that I think is very exciting is a feature that would allow people to launch well, stablecoins are the obvious use case, but it's not just stablecoins. It's essentially assets pegged to some external value. Features similar to that exist on other systems, but the interesting thing about this is that the liquidity is guaranteed by the ledger mechanics.
Why is liquidity important for market stability and health then?
I think even to take a step back, liquidity has a lot of components that are important to kind of address. So one of which is immediacy. So I think about that as how quickly can I get access to markets and how quickly can I trade into and out of this asset or token for another asset. I think about the breadth of the market. So breadth is sort of how you think about the trading volumes at different prices in the order book, and then depth of the market. And depth of the market is really about how many orders there are close to exactly where the price is currently trading of varying sizes, which would imply that you could get a lot of volume through without having much price movement as you're trading into and out of the asset. And then in addition, accessibility is very important. So accessibility is just probably as it intuitively sounds, the ability to access markets to trade in those assets very easily. And that can be geographically or through multiple infrastructure partners, whether it's exchanges or OTC desks or what have you. And the last key attribute of a healthy liquid market is really resilience. And that is getting at the ability for a market to recover from a significant systemic event. So if there was some sort of a market shock, the ability for order books to get back to normality and tighten back to similar prices to where they were prior to that event relatively quickly. And so all of those attributes are very important to a healthy liquid market.
How does deeper liquidity impact services like on-demand liquidity or ODL?
That's a great question. So as you think about the value that we're providing sending flow from the US to Mexico, because we're able to use XRP as the bridge currency between the US and Mexico and do basically instantaneous transactions, we are significantly reducing the cost base sending that money cross-border. And the view that we're delivering and focused on enterprises is true, enterprise solutions to help them perform their business more efficiently. But as we do that, we're really giving them the opportunity to pass on the fee savings through leveraging our technology and infrastructure to their everyday consumers. So, somebody living in America who's working and sending money back to their family in Mexico, we're really thrilled that the work that we're doing is really driving value to the bottom line and to everyday consumers.